Okay, good morning everyone. Today we're going to talk about Crocs, and we're M5. For the case, Crocs is experiencing super growth, and they recently just had an extreme drop in their stock price, about 36%. So this is extremely alarming to everyone involved. For our comparable companies, presently we thought Lululemon, Deckers, and Under Armour were all the most comparable to Crocs, each of them having over 32% compound annual growth rate, all pretty young companies and still growing and developing. As for 5-year comparable companies, we thought Nike and Timberland were the most useful to look at. Timberland because of its product line with innovative features just like Crocs, and Nike being the industry leader. As for our valuation, this is our low growth estimate. We base it off of increasing SG&A costs and off of the decline in the U.S. economy. So considering the industry environment and increasing costs, we thought this is what our growth rate would be and resulting profit margins. This is our high growth estimate. We thought Young's estimate is the highest growth that is feasible. So she assumed that Crocs will increase the number of units sold as well as increasing the average selling price. As the environment becomes less favorable, it is highly unlikely that Crocs will be able to do this. So we don't think it is that feasible, but it is our high growth best case estimate. So for our best guess estimate, we took into account the declining U.S. economy and the decelerating compound annual growth rate, as it's going to decelerate to 5.6% for the 2007 to 2011 period, and the current industry environment, and the expansion plans into foreign markets. So as for our valuation by multiples, as you can see from the 2007 and 2012 graphs, the different multiple values yield different stock prices. So this just reinforces the uncertainty of the firm and their stock price in the future. As for our opinion of the profit margin, we think gross profit margin will remain stable as cost of goods sold are unlikely to increase due to the simplicity of the product. And as for net profit margin, we think it's going to decrease in the future because of increasing SG&A costs, increasing competition, and the slowing U.S. economic growth. As for investing, we definitely think you should not invest. Currently, we think the stock price at $47 is overvalued, even after the 36% decline in the stock price, as our best guess estimate was $43. So, as it's overvalued, it is not advisable to invest.